So we come to the question of how do transactions get caught and then recorded in the accounting system in the first place. Now, for a traditional accounting system, this is normally done by books of original entry, otherwise known as books of prime entry. Same thing. In the exam, pretty likely to refer to these as books of original entry. Although this isn't actually an original entry into the core accounting system. Essentially, a book of original entry is just a very structured form of capturing data so that things can be recorded completely and accurately without, by somebody who doesn't necessarily have much by way of expert training. We take a look at the most commonly used ones are the cash book. Okay, the cash book might be split into two. In this situation here, we've got the cash in book and the cash payments book. Now, the thing that kind of confuses people a little bit on this is that that doesn't record actual cash payments in notes and coins. The cash book records transactions that the entity knows about from the bank account. So let's say, for example, the business owner, probably a sole trader, does an online transfer to pay somebody some money that they owe, then they will know about that straight away and they'll record it in the cash payments book. The data that we record in the cash in book, well, all sorts of things, basically anything where the business generates income, normally from things like if you're a builder, for example, it's going to be work that you've done. We're also going to have sales tax, we'll look at that later on. That can be cash coming in, even though it's actually not ultimately going to be our cash. You might also basically have some side little line of business that isn't your main activity, so your cash in book, you might possibly choose to actually analyse that out between the different types of sales that you make. It's entirely up to the business how it chooses to organise this. So the cash in book recording the sources of money going into the bank account, the cash payments book, all sorts of stuff, but typically recurring transactions like salaries, purchases of inventory for resale, payment of rent, that kind of stuff. We'll basically record it in the cash payments book with the actual description of the cash going out, the amount of cash going out, and some sort of description of where it went to. The petty cash book actually is the cash book. The petty cash book records cash in and out held in notes and coins by the business. For most businesses, this is going to be a fairly small amount, unless I guess you're a retailer. For most businesses in the exam, you can assume that they're not retailers. This is often done controlled using a thing called the impress system that we'll look at later on. So, for example, small expenses in your average office, for example, if you're lucky enough to work somewhere where the tradition is that the company pays for buns on cakes on a Friday, then that would go out to the petty cash book. Once again, what a petty cash book will do is say this is where notes and coins money came from, and this is where it went to. The next thing is a sales day book. It doesn't have to be recorded every day. It's kind of like the periodic sales book would be a better name for it, but by convention it seems to always be called the sales day book. What this is sales on credit. If a sale is made on cash, that would just go, well, it depends. If it's made in literally cash, notes and coins, it would go through the petty cash book. If a sale is made and the payment goes directly into the bank account, maybe, for example, because somebody pays by bank transfer, by credit card or something, then in that situation it would go through the cash book. Okay, if you have sales day book, that's going to feed the sales revenue figure, and it only records sales on credit. Similarly, the purchases day book is purchase of inventory for resale, again on credit. If you buy inventory for cash, then it's going to go through the cash payments book. We then have the journals book, which is something really that is focused really of an awful lot of the stuff you have to do in paper F3. So anything not covered by the others. So very often these are things we call period 13 adjustments because they happen in a kind of notional final period of the year. So you've got 12 months in the year and then sort of notional period 13, the notional 13th month, when you record things like allowances for doubtful debts, or any movements on that, any bad debt write-offs, any accruals and prepayments, frankly, a lot of the other things in the paper F3 syllabus. You might also include, for example, e.g. an expense claim, a private expense claim from the business owner. So if the business owner uses some of his or her own cash to settle a business transaction, well, it's not going to go through the cash book or petty cash book because it didn't actually get paid in the first instance that way around. It's actually an expense that was due to be paid to the business owner. If we show a payment to the business owner, normally it would be withdrawals, but if we record it in the journal book, we can show that it's just a refund of a legitimate business expense. These things might well be recorded in a spreadsheet or a traditional paper-based kind of format, they typically look something like this. So take a look at the cash receipts book, for example. We record dates, the total amount, and then each column is going to have a description of common sources of income. So for example, cash sales, from petty cash, if you've got money going into the bank, remember that the cash book actually records payments to and from the bank account, and other sort of transfers from other bank accounts, whatever it might be. There could be as many as you feel necessary here. Generally speaking, there's maybe, let's say, up to about 10 recurring sources of income that we want to analyse. Okay, what we do is record by date the amount in the total column, and then write the same figure in the column that explains where that cash came from. Now what's going to happen is later on we'll see how we add up the total in each of these columns, and if everything's been done correctly, this symbol is a conventional accounting symbol for everything above that adds up, and that's a conventional accounting system for everything around that kind of adds up to the side. So in other words, the two figures that we've analysed here basically do add up to the 13,322. Everything cross-casts. A cast is accounting jargon for simply to add up. We've got some data there that's been recorded accurately. We're now in a position to keep this book of original entry, hand it over to the bookkeeper, the accountant, in our core accounting system, a thing called the double entry system. Let's take a quick look at one more. A cash payments book. You tend to find there are far more columns in a cash payments book because there are lots more ways in which it is possible to spend money than have money come in. But it's following exactly the same principle. So for example, here we've got 4,500 paid out of the bank. Remember that the cash book records payments in and out of the bank. And we had that as an inventory for resale. We then had 2 payments of rent in the period. So that's gone out of the cash going out figure. And it's been analysed, in other words, the same figure is being put in the column that shows where it went to. Now this is just an extract. It's very likely, particularly if you're doing this in a spreadsheet, you can put as many different columns there as you want. Depends on how many different types of transaction you want to record in what level of detail. They all do follow very, very much the same approach though. Let's take a look at a sales day book. Sales day book, remember, records a list during a period, not necessarily a day, in this situation it's a month, but a list of sales on credit to customers. What we do is keep the date, the name of the customer, the amount, and we might use other information, like here for example we've got the number of days credit that we decided to give to that person. Now what we do is just keep a record of these transactions, and we'll see this later on, that is going to go into 2 places in the accounting system. The figure that the main accountant will be interested in is just how much the total figure of credit sales in each period. Somebody else is going to use the underlying detail and maintain records outside the main accounting system of how much credit we've given to individual people and how much money they have paid us. So we can see at any point in time what the outstanding balance is. But the main purpose of the book of original entry is just to make sure that transactions don't manage to go unrecorded anywhere. By recording them here somewhere, they are going to get into the accounting system somehow.